Next up is James from Super Fast Business. In his talk, he's breaking down his risk-free method for turning flat monthly retainer agency fees into long-term, highly profitable partnerships. In short, how to get paid based on your performance with revenue share deals. James, the stage is yours.
Hi there, I'm James Schramko from superfastbusiness.com, and I'm sharing today how I've been using performance-based deals instead of retainers for my business, and it's certainly been working really well for a lot of the agencies who I coach. So I'm going to talk about what's been working well, why revenue share deals are a fantastic business model. We'll cover how long they take to implement, etc. But generally, these can happen pretty quickly. They're not a today thing like an agency retainer business, but they're a fairly soon thing. So there's a little bit more of a dance you need to do to set them up. But one of the great things is they're so long lasting. What I've been tracking in my own portfolio is they've become far and away the most profitable thing that I do compared to getting paid a fixed amount. And I really think in the agency world, the model is a bit broken with the retainer model. We're going to see a shift more towards people who are actually able to get measurable results for clients. And this performance world has a lot of upside. Even off a few small revenue share deals, you can have a fantastic income. So it really solves a lot of the problems that I've seen in terms of when you want to go beyond just the retainer model. Often you think, oh, I might go into business with someone. But it's legally quite risky entering into business with someone in the traditional sense. You could be very difficult if you're trying to operate across borders in different countries or jurisdictions. The motivation level of partners is usually different, so that's why a lot of 50-50 deals don't work. Sometimes you're overreaching into an area of the business that just isn't your specialty, so you want to be careful about defining what it is that you're helping your customers with. And the thing about profit share deals, which is another way people go about it, is costs are very blurry. Like, what about if you travel to a conference or you buy a new vehicle for the business? Who's paying for that? Is it going to be split? Is that one partner's side of the account, etc.? And it takes a lot of cash to scale into other businesses. But if you want to do the revenue share model, you can effectively be in someone else's business without having to put in any money, without having to be a 50-50 partner, without having to do difficult contracts, and certainly without any huge commitment from your part other than future services you're going to provide. In many cases, it's going to be whatever you were providing as an agency, but instead of getting paid a flat fee or a fee plus a percentage of ad spend, now you might actually get paid a percentage of the revenue increase you can help for that business. Now, depending on what kind of agency you have, that could be really, really valuable to you and for your partner. The contracts or paperwork to do these things is pretty short, and I'll cover that in a moment. Why you should listen to me about this? Well, I've put together several revenue share deals for several years. I've got a nice little portfolio. They're producing very well. But a lot of my clients are agencies, and they've been doing performance deals with their clients, and it's performing really well as well. A lot of them actually speaking in this platform. So I'm sure you'll hear about this. It is a trend. There are different ways to go about this, but I think that's one of the beauties of it. It gives you something different to talk about, where maybe a retainer model is not the ideal way forward. Generally, the retainer model puts a lot of risk on the customer, and it's not a lot of risk for you, but then it stops. They stop paying, they disappear. So in the old days, I think it's been tempting for agencies to just sign up anybody on a retainer and let it just run out. But if you can find the right partner, you can actually scale together. So let's talk about how simple they are to get set up, how easy it is to get paid, why it's so motivating for the business owner. Clearly, a lot of the risk is now on you to actually perform. But if you're good at what you do, this business model is actually pretty good. And if you can build a little portfolio, you're no longer dependent on just one or two retainer clients. You could actually build out a portfolio of business partners. It's effectively becoming an affiliate of an entire business or a whole product line. And you get to leverage your specialty, your expertise. And as an agency, what you have is in demand. And what I have found about these deals that's unique compared to retainers is they can last a long, long time. So let's talk about the steps. The first thing is you want to position yourself as an agency that will consider going on a deal where you feel that you're so good at what you do, you don't ask the customer to pay a cent unless you get them a result. So that gives you a fantastic sales positioning. Decide where you want to operate in the market, and you need to be very, very precise with this. You want to choose the type of client and the type of market where you have already had success with your retainer models, because the retainer has actually been capping your income. Then you build your authority or reputation. Obviously, any kind of trust that you can build up that would attract someone to you would be great. Then the next step is you would systemize your marketing machine. Like, get what you do down so well that it is like a factory and that you can easily replicate a result for the perfect type of client. Then you lean on your relationships and build up those connections, like work really closely with the market that you're trying to attract and build up your database, get your distribution ready where you can send out an email offer and let people know that you're opening applications for this. And this is the thing, when you go open or when you're ready to do these deals, you have to filter deals. You've really, really got to exclude a bad deal before you ever start it. They're a little bit more of a pain to get set up, but once they're set up, they last a long time. But I'm going to suggest you always build in and out. So you will have the ability to get out of these arrangements if it's not suiting you, and your client will be able to get out of the arrangement as well by paying you out, which is nice. So let's talk about filtering the right deals. Firstly, is what assets do you have? What are you particularly good at? What does your agency do that no one else can do as well as you can? That's what you bring to the table. You want to also spot the client that you would normally take on a retainer, but you think is going to absolutely crush it. They're going to go so well that you want to get in on it like an investor, because this is really what you're doing. You're investing some risk in the potential of that customer. So get to know them first, because these deals are quite trust-based. So often I will convert a traditional retainer type client into a performance deal over time. I might get to know them through them taking the risk and then proving themselves. And then I realize, hey, this client is going to go to the moon, so I want to get on that ride. Then see if you feel like you could help them for a long time. If you feel you trust them and they fit your perfect customer profile, then see if you can start that conversation. You might want to do a sort of a little bit of a diagnostic. It's almost like you would buy their business or they would be buying your business. You want to have a little bit of that open discussion about what the business looks like. In the same way I would if I was taking on a retainer client, wanting to make sure that I could guarantee success. Because remember, some of the risk is on your shoulders in terms of wasted time and energy, but you don't really have a financial exposure. It's really more the opportunity cost of what you're losing if you were to take a retainer. But the way these deals work is you usually get paid a little less up front, but you get paid way, way more down the track. Some examples: I've had deals where I'd normally get $3,000 per month turn into $10,000 or $11,000 per month within sort of 9 to 12 months. So from then on, they're paying me 3 or 4 times more than what they would have paid, and we've gone into a way deeper relationship. So of course you might get some quick wins. It's always good if you can. But as soon as you feel like they're going to have big wins, that's when you want to get in early. Ideally just before they see how well they're going to go. In terms of deal flow, you get people to an application, screen those applications, and then it's contract time. If you've done your sort of dance, your due diligence, and you want to do a deal, you'll need a contract. And I would suggest, and I'm not a lawyer, but you really need a written agreement. You don't want a fuzzy deal. You don't want a handshake agreement on this kind of deal. And I'll tell you what some of the potential red flags are. Sometimes the red flag is just too easy. People will throw themselves at you and be willing for you to get paid on how well they're going to go, but they're going to expect you to take all the risks. They're going to expect you to basically do everything for them. And you may not want to do that. You may not want to put a lot of energy or time into a potentially sinking ship. So if it's too easy, that's often a red flag. The other things that could potentially happen is that they're selling their business or their business gets sold. So you'll want to make sure into your agreement goes a provision that if it gets sold, they pay you out a bonus. And the bonus might be a multiple of what your royalty is. I usually look for a multiple of about 24 months worth of my royalty, which is averaged out over the last 6 months. That way I'm kind of selling the business or my position in the business. Now there's a risk they don't pay you, so you may want to really clearly identify what happens in the case where they don't pay you. They might make up their numbers a little bit, and that's not good if they're making up the numbers. So you want to have a provision to audit the numbers and a very clear reporting mechanism where you can see. Now, if you're an agency, often you have access to an ad account. So you could probably still set up a very simple deal where you get paid a percentage of their ad spend, but instead of a base salary or a base retainer and then an override, you might just have a percentage of total ad spend. It might just be a simple number. Other risks are that they clone whatever you do with them into a different business. So you'll want to have a provision for that in the agreement. The other challenge is the business might not grow. This is a pretty straightforward one, but these deals really only work if the business intends to grow or if you can grow it. That's why you might be lucky enough to get a business that's very early on and you could get a percentage of revenue on their entire business, or you could get a percentage of their ad spend on their entire account, or maybe it starts from when you start helping them and everything they had up until that point is their break, okay? And they get that for free and they're not the amount over that. That's why you have a really strong sales argument to say, listen, if I can't grow your business, don't pay me a cent. If I can, would you be willing to pay me 10 cents in the dollar, or 5 cents in the dollar, or 4 cents in the dollar? So it depends if you're going off revenue. It depends if you're going off ad spend. Whatever the metric is, make sure it's very clear. Check that the business partner that you're thinking of going into business with has no bad press or skeletons in the closet. Do a little bit of research there. Make sure it's not a market where you want to go into yourself, so that it doesn't look bad if you end up not going ahead and then you go into that market yourself. That could be a bit awkward. Make sure that the agreement covers what happens if the parties no longer survive. Like, if they pass away or something, you need to have a clear plan in place as to what happens to the deals. So when it comes to the agreement terms, there are some basics you need to really agree on who the client is, like what entity, and what is the actual project. Is it the whole business? Is it a product line within the business? What do you actually promise to deliver? I find it's generally good to be not too specific here. You want to be basically doing a royalty agreement to provide them intellectual property and services, but you don't need it to be too specific. If it's very, very specific, these are all little catches that can bring a deal undone if people get picky on it. So keep it fairly general. You can word it differently. You could word it as services. You could word it as a license for intellectual property. You could be selling distribution or access to a network. Depends on what type of agency you have or what it is that you've been doing. I always like to get a benchmark or a baseline for what their current level is. And generally I work on what the agreed royalty is on the amount over that. And it's generally going to be a percentage. And generally the percentages are going to range from 4 or 5% up to maybe 20%. But again, depends on the business and depends on their revenue, depends on their profit margin. Don't be too greedy, because if you make the deal unsustainable, then they'll just buy the deal out or they won't accept it in the first place. You need to specify when it's paid. So most of my deals are paid the month following the previous month. So they pay on the 10th day of the month after we close the month off. And it's usually on the amount of revenue net of refunds. That's the easiest way. The agreement should set a start date. You should have a method of tracking. You should have all your disclaimers and confidentiality agreements built into the agreement. A good lawyer will help you with this. There should be restraint of competition. There should be an acknowledgement of costs. what would happen in, if there were costs to audit or costs to dispute an amount. You should stipulate the governing law. What happens if payments are late? What happens if they sell the business? What happens if they want to pay you out? And I think it's good to build in a buyout. I know a lot of the deals I looked at when I wanted to start setting up these models had no provision for that. And at some point, the customer gets a bit annoyed at having to pay these big royalties, so they start not paying it, or they want to get legal or try and exit it. Better to just build it in from day one because the expectation is set. Think about any other termination events that could happen. Just step back from it and see, is it fair for everyone involved? And if so, you've probably got a good agreement. The next step is just communicate all of this, set up a discussion back and forth. One of the tricks to avoid is don't let their lawyer rewrite your agreement for you. Just get them to tell you what they want changed and let your lawyer rewrite it until you can find a happy platform. Then you get to work. Start the campaign, work on the account, get it growing, start sending off your invoices and get paid. And to this date, I've still been paid for every single invoice we've sent. Of all the deals I've started, I have trimmed a couple, but they're usually where they just didn't perform as I was hoping they would. And it's a little bit like venture capitalists, I suppose. But the top few deals have performed wildly better than I thought they might. The bottom few performed worse than I thought, and so I exit. So I always build in an exit where I just give 30 days notice and I'm out. And that's it. So I can walk away from these deals, and that's really important. And then it's a matter of just ongoing implementation, tuning, compounding the results, getting that deeper relationship, seeing what you can possibly do for your client, and making sure your reporting is always maintained. Sometimes your client needs a nudge. I have a member of my team who just sends off a request for numbers, and then we send off the invoice, and then we check for payment. So it's a one VA type role in my business to do that monthly accounting, reporting, and follow-up. And of course, these are super creative, open-ended things. What I really hope you take from this presentation is that you get stimulated with the idea that there is another way than just doing that monthly retainer model. Look, every agency does retainer models and it's commoditized. Think of new ways to approach your clients. Identify of your entire customer portfolio who are the skyrockets that are going to go to the moon, and see if you can put them on a different arrangement, and be prepared to make a few errors along the way to find your feet. But what you might have in the long haul is you might have clients who have been with you for many, many years who become deep embedded partners. You're literally going into business with them using your skills, and you end up with a wonderful little portfolio that keeps paying you every single month like an oil well, and they're not breaking like the usual retention retainer model. I'm James Schramko from superfastbusiness.com. I hope you've enjoyed this discussion. Thank you.